Hey everyone, welcome to this explainer. Today, we are going to completely decode a highly technical institutional weekly market report. We're uncovering exactly where the so-called smart money is flowing in the Indian equity markets for the week of July 6, 2026. This data is absolutely packed with structural transitions, deep volatility compression, and a really active sector rotation. My goal? To break all the complex stuff down so you can see exactly how the big institutions are maneuvering behind the scenes.
Okay, so we're going to take a top-down funnel approach today. First, we'll look at the macro shifts in market setup. Then we dive into index structure and smart money, followed by sector rotation and capital flows. After that, we're getting into options, chains, and volatility traps, the top weekly swing trades, and finally, we'll wrap up with the exact institutional trading playbook. Let's get right into it.
Section 1. Macro shifts and market setup. To really deeply understand the Indian markets right now, we actually have to zoom out and look globally first, just to see how the macroeconomic pressures are shifting in our favor. So the crucial point here is this striking divergence. Global geopolitical stabilization is directly translating into a massive structural advantage for net importing economies like India. We've got this recently negotiated peace treaty in Qatar between the United States and Iran, right? And that has fully reopened commercial shipping lanes in the Strait of Hormuz. For a net energy importing economy, this is a massive tailwind. It directly reduces imported inflation, improves our fiscal balances, and it literally gives the RBI significant headroom to just focus on supporting growth rather than constantly fighting inflation.
And this number right here brilliantly illustrates the macro payoff. Brent crude oil has plummeted to $71.55 per barrel. That acts as a massive disinflationary relief rally, completely expanding Indian corporate margins. Remember, crude spiked near $110 just a few months ago in April and May. So the structural correction back down to the low 70s, it completely changes the input cost dynamic across industrial raw materials and chemicals. It creates an incredibly supportive baseline for domestic equities.
Moving on to Section 2, Index Structure and Smart Money. Let's see how these global tailwinds are actually showing up in the price action and domestic index structures.
When you look at the primary trends, it's kind of like a tale of three indices. We can clearly see the Nifty 50 is in a strong bullish expansion. It broke cleanly out of a symmetrical triangle and is holding above the 100-day EMA at 24,130. But Bank Nifty? Well, it's dragging its feet. It's trapped in this neutral to bullish flag consolidation pattern, and it really needs to clear that 58,500 resistance zone to get moving. Meanwhile, the small cap 100 is just in full momentum expansion, proving that domestic liquidity and retail accumulation are incredibly robust right now.
Now this part is wild. Here is how the smart money set a classic trap at the Nifty's recent 24,378 high. They executed a textbook market maker trap to trick retail breakout buyers. Basically, they induced that classic early morning FOMO and then aggressively reversed the price down into a fair value gap. Once the retail liquidity pool was swept above that swing high, the big institutions booked their profits and generously left those late-stage buyers holding the bag. It is just a textbook liquidity grab.
Section 3. Sector rotation and capital flows. So knowing that retail traders were trapped at the highs, we have to ask, where did the institutions actually rotate their capital?
The capital flow is super clear. Smart money heavily accumulated realty and IT while aggressively dumping weak sectors like PSU banks. Realty was an outstanding outperformer, gaining nearly 8% for the week. But the really fascinating move was in IT, which saw a massive single-session rebound. At the exact same time, capital aggressively fled from high-beta, overvalued spaces, which triggered technical breakdowns in the PSU banking sector.
And here is the absolute golden nugget, the ultimate institutional clue. Foreign portfolio managers used a sharp drop in global AI stocks to secretly funnel capital into domestic Indian IT to balance their global portfolios. So while global AI and semiconductor stocks corrected 8 to 10%, the Nifty IT index was quietly driven up by 4.64% in a single session. They're using our IT services firms as a lower beta, oversold value play during periods of global tech froth. Absolutely brilliant maneuvering by the smart money.
All right, Section 4, Options, Chains, and Volatility Traps. With capital successfully reallocated, let's look under the hood to see the mechanical volatility traps being set up this week.
The India VIX has literally collapsed to a multi-month low of 11.80. It's like watching dead calm seas right before a massive, unpredictable storm. Market participants have significantly reduced their expectations of near-term price swings, and we're seeing severe Bollinger Band compression across all the major indices.
So what does this actually mean? Well, this deep volatility compression means absolute option premiums are cheap. This sets the stage for a really violent directional move if key structural levels are suddenly broken. Because implied volatility is so low, directional option buyers suffer from rapid time decay, which gives a huge edge to range-bound sellers. But it also means that out-of-the-money calls are incredibly cheap to buy, which institutions use to capture sudden, explosive spikes in momentum.
So here's how a squeeze could happen. If the Nifty pushes past the critical 24,300 trap level, we are going to see a rapid chain reaction. Intraday call writing is heavily deployed at that 24,300 strike. It's the exact gamma flip zone. A sustained trade above it forces those riders to panic and cover their short positions by buying the underlying asset. This creates a violent feedback loop, forcing market makers to buy heavily, triggering a massive gamma squeeze straight up to 24,450.
Okay, Section 5, Top Weekly Swing Trades. Armed with all this structural data, let's break down the specific trades the institutional footprints are pointing toward.
Here are the top 5 bullish setups boasting really high probabilities right now. We're talking Max Healthcare, Ultratech Cement, Sumitomo Chemical, Zenzar Tech, and Adani Enterprises. Max Healthcare and Ultratech are really leading the charge with heavy institutional accumulation and strong technical breakouts. Notice the theme here? It's defensive pharma, structural cement, and oversold IT. Sumitomo Chemical even saw its volume spike over 4.5 times its 30-day average. This is highly convicted capital flowing into very specific, strong charts.
On the flip side, you want to stay far, far away from these high-conviction bearish candidates. Institutions are heavily liquidating capital goods, so we're seeing distribution in GE Vernova, T&D, Hitachi Energy, CG Power, Union Bank, and PB Fintech. These stocks underwent high-volume structural breakdowns, literally losing massive percentages in single sessions. The data clearly shows institutional distribution, effectively dumping these overextended power infrastructure and PSU bank components to lock in profits.
The logic here is pretty black and white. Smart money is systematically buying defensive healthcare strength while simultaneously dumping overvalued power infrastructure. Max Healthcare showing a robust higher high formation with strong volume breakouts. But in stark contrast, CG Power is breaking below key moving averages and its RSI completely broke down from high momentum levels. It is quite literally a perfect real-time example of institutional rotation at work.
Finally, Section 6, the Institutional Trading Playbook. Let's distill all of this macro research and micro options data into a concrete execution plan for the upcoming sessions.
To navigate this specific low volatility environment, the institutional playbook mandates a really strict allocation model. They put 50% of capital in diversified equities, protected by a 30% allocation to hedged derivatives like iron condors. And then there's a 20% tactical cash buffer. That cash buffer is absolutely crucial. They hold it in high-yield debt or liquid funds, specifically so they can deploy it when margin opportunities or sudden volatility expansions occur.
And risk management? It's non-negotiable. Regardless of whether you are an aggressive gamma scalper or a more conservative swing trader, the smart money rigorously caps risk at exactly 1% per trade. This ensures capital preservation. Plus, they use a strict 3% absolute weekly drawdown cap. If cumulative losses hit that 3% mark in a single week, all proprietary positions are liquidated and trading ceases until the next cycle. That, right there, is how you survive in this game.
All right. While the short-term structural trends look super confident right now and the macro data is supportive, I want to leave you with one final thought. There is currently a calculated 63% probability of a super El Niño forming in Q4 2026. This presents a massive risk of agricultural output shocks that could easily force the RBI into a sudden hawkish pivot. So, when that systemic weather shock hits and revives food inflation, will your portfolio be ready for the storm? The smart money is definitely enjoying the calm seas right now, but they are absolutely keeping one eye firmly on the horizon. Thanks for tuning into this explainer, and stay sharp out there.